We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides.
And we're back with Andrew Moran, economics editor, discussing the collapse of Silicon Valley Bank. Earlier in the show, we talked about the industry trends and how SVB may have been a victim of its own industry. But now I want to dive into the solutions being offered. Now, Andrew, you and I, we are both fans of films made more than 50 years ago. And the first thing that kind of popped into my head when I heard about the Silicon Valley Bank issues was It's a Wonderful Life, and how George Bailey, played by Jimmy Stewart, and how he has a bank where there are depositors rushing to get their money out. Now, is it that kind of situation?
Okay, so before I dive into that, I would like to say first that I wrote an article I think it was last Christmas or Christmas before, using that film as a critique on the fractional reserve lending system. Fractional reserve lending system is one of the factors why you have these banking issues in the first place. Because when you deposit your money, the money just doesn't sit there. The money gets loaned out of Bill's house and Julie's house, and then that's James Stewart's summary of what fractional reserve lending really is. Now, is this a broader issue of people withdrawing their money? Yeah, that's what happened in recent days. A lot of people went to First Republic Bank. A lot of people went to Silicon Valley Bank. A lot of people took the money, of course, $10 billion from Signature Bank. So you do have runs on the banks happening. Now, is it going to happen on a wider scale? I'm sure a lot of these big financial institutions are going to limit the withdrawals. They'll employ similar methods. There is a widespread bank run, which I don't think is going to happen at this point. But overall, I mean, yeah, that was the film summarized what's going on.
So who's Mr. Potter in this scenario?
Also, one thing too about Mr. Potter is that I don't really view him as a villain. I think what's wrong with that Pottersville that's Jimmy Stewart envisioned, with the strip clubs and the gambling halls.
You can actually, believe this or not, read Andrew Moran's defense of Mr. Potter in It's a Wonderful Life on the pages of libertynation.com. True facts, true story, no joking. So,
but if you want to find a villain in this whole thing, I have to once again refer back to the Federal Reserve and perhaps even the federal government. The Federal Reserve's season of easy money era led to this issue. All this money was injected, all this freshly created liquidity was injected into the system. It benefited primarily the financial sector and the tech sector in those 2 years. The other issue is, and of course, those extremely low interest rates that also benefited a lot of people. The other issue is the federal government. A lot of economists I've spoken to, the new talking point is that it's all Trump's fault because he rolled back some regulations out of the Dodd-Frank bill, including raising the threshold for the whole too big to fail stress tests. But aside from that, the whole sector is completely overregulated. So when you have an overregulated system, financial institutions are going to take on more risk, and they're going to use client deposits because of fractional reserve lending to employ those risks. And then, of course, they try to offset those risks by taking on secure instruments. But when those secure instruments are crashing, as we've seen over the last year, then you have this whole problem, festering, and it's going to, lead to perhaps a wider issue. And then also one more thing before you go on. When the Federal Reserve and the federal government bail out, whether it's depositors or management or investors, you have something called a moral hazard. In economics, a moral hazard is when a party takes on risk and it's not incentivized to reduce that risk because they're not going to take responsibility or account for the full cost of that risk. So if you have the federal government saying, or the Federal Reserve saying, oh yeah, we'll just give you $10 billion, you have access to all this lending facility because of your bad mistakes or because depositors didn't do their due diligence, then the whole thing is just going to completely continue. And then, of course, in the size and scope of the current financial system, which is $22 trillion, if you have more of this happening, then you're going to have an inflationary crisis occurring.
So you're saying that the moral hazard comes about because essentially in a competitive market, certain banks are being incentivized to take higher risk strategies because they know that daddy's Federal Reserve credit card is waiting.
Yeah, exactly. Yeah, exactly. That was one of the bigger problems during the 2008 financial crisis. You had a lot of these big banks were just bailed out by taxpayers this time. But you could also make the case that even this bailout too could be some sort of taxpayer fund as well, because you have higher.
Well, let's talk about that, Andrew. Now, Joe Biden's put together, and a lot of media outlets have been saying that Joe Biden's whirlwind 72 hours to save the banking system, and it's a great narrative. I'm not sure entirely how. how true it actually is. But he proposed a series of measures that would draw on certain funds and what. Now, what I'd like to do, Andrew, if I may be so bold to ask, is to explain this to me as if I were a rather slow-witted 5-year-old.
Wait, is that a reference to my son? I take
No, not at all. For those who don't know, Andrew Moran actually speaks to his son exactly the same way he speaks to us, the audience. I'm not saying his son understands it, but he does speak that very way to him. So explain it to me, how this is going to save depositors without disrupting the industry.
Well, okay, so it was a three-pronged approach. So the first one was, as I said earlier, the FDIC, they're insuring deposits that even exceeded the $250,000 at the SVB, which is dangerous because, as I noted earlier, the SVB has $150 billion in reserves and or losses, and the FDIC only has $125 billion in their reserves. So that's one issue they're doing. The other issue is that the Federal Reserve is lending up to it has an unlimited fund, as apparently it's according to what I've seen. Up to 1 year lending facility to banks, savings associations, credit unions that were impacted by the SVB failure.
Okay, so
and then one more thing.
No. So that means that the banks that need to pay the depositors to prevent a complete run, they can take money and as a loan, a structured loan for a year to pay out the depositors. And that will prevent the bank. Right. Good.
And then the Treasury, as a backstop measure, they're going to offer $25 billion just in case the Federal Reserve has losses with these loans. Now, from what a couple of sources I've spoken to, they say that that's not that money's going to be unnecessary. It's not going to be needed because, of course, the Federal Reserve has access to a printing press. What's $25 billion the Treasury Department going to do at this moment? So that's the three-pronged approach summary of of how they're building.
It's the Hillary Clinton defense. At this point, what does it even matter? And we'll be back with Andrew after this short break talking the runaway inflation train. Don't go anywhere.
We dismiss history at our peril.
Liberty Nation Radio with Mark Angelides. Entertaining, informative, and just plain fun. Watch Liberty Nation's The Conservative 5. Produced by conservatives for conservatives. C5's The Left Free Zone. Hosted by Liberty Nation's Lisa K. Donner. Joined by a raucous, irreverent panel of authors. Deconstructing leftist narratives. Debating the hot topics. And remembering to laugh. Join the official conservative safe
You only
space.
did that to piss Jeff off.
Liberty Nation's The Conservative 5.